Good afternoon, everyone. Nick Ware here with Farmers Insurance. Thought I'd pop in and cover the California Fair Plan a little bit. So I ran into an issue last week with a lender where they really didn't understand the Fair Plan. It almost sounded like they had been misled because they were so strong in their beliefs that it was a backup policy, not a primary policy. So what the California Fair Plan is it's a last resort insurer. It comes into play a lot of times in the high fire risk or high risk in general areas in California. As you probably know, we've had quite a few fires here over the years, and it's made it exceedingly more difficult to cover homes in those high fire areas. Here in Fresno, that would be the surrounding mountainous area, like Squaw Valley, North Fork, Coarse Gold, Oakers. So when a regular insurer can't cover you due to your fire line or protection class, which is how easily you'd be protected in the event of a fire, then you have to resort to you may have to resort to the California Fair Plan. So since it is a last resort insurer, that policy is pretty basic, but it will 100% of the time be your primary policy. So if you have to resort to the Fair Plan, that is your main policy. And it's the only policy that will be required by your mortgage company or lender, whether they know it or not. So it covers everything, all of the primary coverages, like fire and lightning, internal explosion, optionally, windstorm and hail, explosion, vehicles, smoke, volcanic eruption. Not a lot of that in California, but the Fair Plan will cover it. And also optionally vandalism or malicious mischief. Now, the things that it doesn't cover are such things as personal liability. That's the biggest one, I would say. Theft, falling objects, weight of ice, snow, or sleet, accidental sudden discharge of water. That would be like pipe bursting, freezing, things of that nature. So even though it covers all those main coverages, if you want all those things that it doesn't cover, you need what's called what we call a companion policy. It's known also as a difference in conditions policy. So those policies often look exactly like a regular homeowner policy, and I'm thinking that's where the confusion came in with some lenders. The Fair Plan is not super easy to work with, especially when you're working with a lender that's trying to close on a home. So I don't want to speculate, but I'm thinking possibly an agent, put their companion policy or their difference in condition policy for the lender and said this is the primary policy, but they have to have the CFP as a backup. But we'll let the clients take care of that on the side. Doesn't have to work with the loan. That should never be the case. But like I said, those difference in condition policies are super important. They will fill those gaps in coverage. There is another option. If you're only worried about liability, there are liability-only policies for homes. But regardless, like I said, that California Fair Plan or CFP policy is the primary. That is the one that your mortgage company needs to close on your loan. So you can look up the information. It's all on the net. You look up cfpnet.com. That's the California Fair Plan's website. They have lots of information on their policies there. But you do want to make sure that your agent exhausted all avenues first before resorting to the Fair Plan. And if you do have the Fair Plan, you want to shop it every single year, which is a little weird to hear coming from an agent. But it's just more ideal, typically, to have one policy that covers everything as opposed to having two, and especially with the cost involved. But anyway, so that's that. If you have questions about that, feel free to reach out to us. You can catch me on email nware@farmersagent.com. You can call the office 559-323-4515. You can text us 559-560-5436. And I hope you guys are having an awesome, safe week. Looking forward to this New Year's Eve weekend. Okay?